Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, April 21st. Markets started the week on the back foot as renewed Middle East tensions weighed on investor sentiment, but the now familiar pattern may already be re-emerging. Early week sell-off, followed by cautious optimism on hopes of a diplomatic breakthrough and potential rally. In between, eyes are also on economic data, corporate earnings, and Mr. Warsh's hearing in the US Senate. So we will break down what it all means for financial markets. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the week started on a sour mood as tensions in the Middle East flared up again during last weekend, and uncertainties continue regarding what will happen when the 2-week ceasefire in the Middle East will come to an end, and that will be by the end of Wednesday evening in Washington time. So major US and European indices kicked off the new week, giving back last week's gains, but they're still at quite high levels. That's just a touch below a record high for the technology-heavy S&P 500 and some 2.30% lower compared to February all-time high level for the Stoxx 600 index. And the futures are in the positive again this morning at the time I'm talking here, on hope that US and Iran will finally find an agreement this week before the Wednesday deadline, and that the markets would rally. So that would really match the almost 2-month pattern of tensions increase over the weekend. Markets sell off on Monday. They hesitate on Tuesday, but then the mood improves on optimistic but not necessarily funded and often unilateral announcement from the US, which leads to a market rally into the weekend. Then the weekend brings bad news and this pattern repeats again. And well, latest news suggests that Iran may be willing to join in the negotiations finally, and that could maybe give way to an agreement. So fingers crossed. But what was interesting yesterday in market action is that crude oil actually gave much of its early week jump during yesterday's trading session. US crude, for example, retreated almost 5% to close Monday's session, 2.80% up only, while Brent crude was up by only 1.5% at the end of the day and is consolidating near the $95 per barrel level this morning on hints that, again, Iran may join these negotiations. So as a result, this is why the energy stocks barely benefited from yesterday's early jump. SPDR's energy sector ETF, for example, was rather flat yesterday on oil's inability to consolidate and extend gains despite this highly uncertain geopolitical environment. And then oil prices have been coming down since a while too. But why? Why are oil prices coming down when the Strait of Hormuz remains actually closed and the prolonged period of disruptions there are decreasing the amount of energy available for months ahead? Kuwait's Petroleum Corp, for example, declared yesterday force majeure on its crude and refined products shipments, saying that it will not be able to meet its full obligations due to circumstances outside its control. And there is no magic. The longer the Strait of Hormuz disruptions continue, the scarcer the energy will get, considering that around 20% of oil flows globally used to transit the Strait of Hormuz before the war started. On the other hand, Houthis are also threatening to attack oil vessels that Saudi is now rerouting via the Red Sea, and it would take years and a lot of investment and sustainably higher oil prices compared to pre-war levels to justify these investments for other oil producers, for example, like Brazil, Guyana, Suriname, and Venezuela, maybe, to fill in the gap. So why? Why are oil prices coming lower despite geopolitical tensions and supply disruptions? Is it just hope? Well, the answer is certainly not. Hope is clearly a part of the equation, but one of the reasons that keeps oil prices from rising more is, one, the release of strategic reserves from major countries may have helped keep flows for a while, though they are drying up, obviously, and that's a problem. But two, and more importantly, the demand destruction has already started. It is actually reported that the European refineries, for example, decreased their demand due to higher costs, and that's obviously leading to lower oil prices. And remember, this is exactly what we have discussed at the start of this war. We had said, remember, that oil prices cannot rise infinitely, as higher oil prices would weigh on demand. And this is seemingly what's happening today and keeping oil prices or oil rallies in check. Therefore, and looking at oil price charts, it becomes clearer by the day that the downside correction trend is being established despite absurd, fake, and hectic news and high geopolitical uncertainty. So from a price perspective, US crude, for example, will remain in the bearish medium-term consolidation zone below the $94 per barrel level that matches the major 38.2% Fibonacci retracement level on this year's oil rally, and could further retreat toward $80 to $87 per barrel range with or without peace in the Middle East. But a peace scenario obviously would accelerate this downside correction. So what does that mean for the energy complex? Now, energy stocks could retreat along with the oil prices. This is what it means. The SPDR's energy ETF, for example, has slipped on Friday into the medium-term bearish consolidation zone after slipping below its own 38.2% Fibonacci retracement on year-to-date rally. But the latest price spike still boosted earnings in major oil companies, and the upcoming earnings from these energy giants will be quite interesting to watch, because we could see strong results, quite strong forecasts, and share buybacks that could eventually throw a floor under the downside correction. Elsewhere, the technology stocks, the AI-related ones particularly, are back in focus as latest earnings from technology names came strong enough to tame part of worries regarding these massive AI infrastructure spending and unclear timeline for return on these investments. But technology is playing in its own league anyway, with news only pointing at expansion of AI models and applications and adoption, increasing the need for more chips, more data centers from the enablers. And in this context, Marvell Technology surged nearly 6% yesterday on news that Google is looking to develop 2 new AI chips to compete with Nvidia's, while Amazon is putting another $5 billion into Anthropic and may inject $20 billion more to strengthen its position in AI. As such, Roundtree Magnificent 7 ETF successfully rebounded from around a key Fibonacci support that prevented this index from slipping into a medium-term bearish consolidation zone itself. And with technology valuations looking cheaper today compared to a few months ago, investors are now willing to look past the uncomfortable leverage levels and the return on investment mix. Zooming out, geopolitical and macroeconomic backdrop remain, quite less than ideal right now, and investors are looking at the economic data to see the extent of the Iran war's implication on global economies. In this context, later today, the US retail sales are expected to have jumped in March, but that jump is due to higher energy prices. So filtering out that jump in energy prices, the sales may have come under pressure. That's going to be an important indication for investors regarding the consumer health in the US. In bond space, the US 2-year yield has been easing since the end of March peak on bets that the rising energy prices would have a negative impact on the economic growth in the US and may hence require a soft monetary policy from the Federal Reserve, despite potential rise in the inflation levels in the coming months. So today, eyes are turning toward Kevin Warsh's Senate hearing for signals on where the Fed policy may be headed next. Kevin Warsh has been insisting, remember, on the idea that AI could eventually increase productivity and decrease price pressures, which would allow the Federal Reserve to cut the interest rates, and that despite a short-term spike in the inflation levels due to the Middle East war. If he maintains this rhetoric, short-term yields in the US could ease more and give support to equity markets. But remember that Warsh has also been very critical about the Fed's outsized balance sheet, and a reduction of that could hurt liquidity and equities, and he's not sure to be taking the helm of the Fed on May 15th if his nomination is blocked until the investigation on Jerome Powell is over. But in all cases, activity on Fed funds futures doesn't suggest a rate cut in the US before December this year, but obviously the predictions in the market are highly dependent on the Middle East outcome, that nobody knows what will happen there and could change quite rapidly. So the only certainty is still uncertainty, but equity traders don't seem to be much bothered about it. at least for now. So let's see what the rest of the week will bring to us. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.